Welcome to the Wisdom Lifestyle Money Show. I'm your host, Scott Dillingham. The goal of the show is to show you how you can grow personally, financially, have a larger net worth, and leverage your largest asset to help you develop the person you want to be. I take you through all the steps I did from being nothing to being told that I was nobody and I was never going to accomplish anything, from getting kicked out of high school to owning a multi-million-dollar real estate portfolio in my own company with more than 20 employees. You'll meet our partners, you'll meet our friends, and you'll quickly discover how you can improve your life. So listen in and enjoy the show. Welcome to the Wisdom Lifestyle Money Show. I'm your host, Scott Dillingham. Today I have a very important guest that you're going to love meeting. His name is Mike Peters. He runs our commercial mortgage division here at LendCity Mortgages. Welcome, Mike.
Welcome, Scott. Pleased to be here. It's about time that we were able to find the time. We've been so busy with commercial mortgages.
Yes, I'm so glad that you're here. And I know our show is mostly based on for investors. But one of the things that we always do before we kind of dive into the nitty gritty is we go over your upbringing and how you got to from a child to here. That's it.
I'm a born and raised Windsor, South Windsor boy. Went to Massey High School. Had a great childhood. Lots of friends. My dad was a very successful businessman, and so we didn't really want for anything. Took me a while to figure out what I wanted to do with my life. I always had a keen interest on why things were placed where they are. For example, why is that Tim Hortons there versus there? How many pizza parlors can you have on a block? And so I ended up going to University of Waterloo. I took urban planning at the University of Windsor first.
Okay.
And then I decided to work for a while at Chrysler's on the line. I've held several jobs before I finally got serious about school. Got into the University of Waterloo as an adult student and got my master's degree in economic development.
Okay.
That took 5 years. Came back to the city of Windsor because of my love for the city of Windsor. I was the youngest certified economic developer in Canada. I was the only one to hold both a master's degree and certification, and I was highly recruited across the country. But I came back to Windsor and immediately was part of what was called Prosperity 2000. And this was a collaborative of about 300 community leaders during a recession where we knew we had to come up with a strategy because of how strongly we were tied to the automotive industry. And it was basically a diversification strategy that a lot of the strategies that you're seeing come to fruition today, the foundation is back in those days. It was a real exciting initiative to be a part of. But one of the things I found frustrating being in municipal government is just it moves like a tortoise.
Yeah, super slow, yeah.
We hear that about guys right now trying to get permits for various types of constructions, these third houses, the gentrification, that kind of thing, that are real important to our city. So I just couldn't take the slow pace. So I wrote an economic development strategy for Union Gas.
Okay.
Sent it to the president of Union Gas, and within a week, I'm sitting with the vice president of marketing, and he says, come to Union Gas and set this up. Because I saw where in the U.S., the utilities were heavily involved in promoting regions. Everybody's competing for the same dollars, right? It all boils down to you don't want to trade local dollars. You want to bring in new dollars if your local economy is going to grow and expand.
Okay.
We were for too long just trading dollars in Windsor. Automotive guys' income was going to the grocery store and other things, buying new cars, but it all stayed local. So if you're going to grow the economy, it's about promoting yourself outside the region. I worked at Union Gas. That was during a period of a lot of acquisitions. We purchased Centra Gas, and I ended up with 815 municipalities and a budget of about $500,000. And it was kind of difficult to figure out, do you give it to the Stratford Festival? Do you give money to the new arena and put your name on it? What do you do? It was a lot of hospitality suites and entertaining a lot of politicians. I went to all the annual conferences. I was AMO, you name them, small municipalities, large municipalities, and just really got a good feel for the bigger province and each of their unique niches. One of the groups I was with was the Canadian Council for Public-Private Partnerships,
Okay.
which was a really neat organization. It was high-level executives, and each quarter we would travel to a different jurisdiction in Canada, taste the flavor of Halifax. We went to Saskatoon and ate bison, saw the cliff where the native indigenous people would run the buffaloes off the cliff. But I got to hear what CIBC was doing in their local communities. And we went to one small mining town that had lost the mine, and the individual who owned it, basically owned the town. He was one of the first to do the murals. And the whole town went from mining to tourism, just like that, because of one strong individual. And so I brought that concept to Essex. Town of Essex was the first to adopt it, and murals all over the town of Essex. I then again became disgruntled with the slow pace of basically as a monopoly. So I went from bureaucracy to monopoly. My background in economic development, I did some cartography, and I also designed the marketing strategy for this region, which required that I get in an airplane and take pictures of industrial parks. And I'd fly over golf courses, and I go, you know what, I want to get into the golf course mapping business.
Mm-hmm.
And so that's what I did. I actually quit Union Gas and started a golf course mapping business, mainly in Florida. I had partnerships with all of the senior architects, the big name people, etc. And then September 11th hit, couldn't put any planes in the air. And I had about $1 million worth of contracts. So got into homeland security mapping, targets for potential terrorists, such as amusement parks, government campuses, university campuses. And then I got into fleet tracking. I got into equipment tracking. I've just been an entrepreneur ever since. And that's basically since 1999. Then I found that so I have a personal desire to assist business, which goes back to my economic development days. We're trying to diversify, like getting the plastics companies that are making taillights to potentially make Halloween baskets, or anything out of plastic, toboggans, etc. And so I was successful at that. And I enjoyed that. But I had the entrepreneur flavor in my genes from day one. Partnered with an engineering firm. We were looking at remote monitoring of water wells. There's 800 water wells in Ontario that there aren't being monitored. Contamination is an issue. And one of our customers wanted some financing, so I got into business finance. Okay. And represented a company out of Toronto. They knew, because of my background being as diverse as it was, an entrepreneur, my master's degree, and all my other experiences, and my relationships in the province, that I'd be a good candidate to represent them. One of the first things I did was go to the local incubators, accelerators, etc., and see if there was any small companies that needed some assistance in finding financing to grow their business. And as a result of that, I was invited to work with the accelerator to try to figure out some things to get them growing and expanding. And one of the things that we determined is that they should probably get a consolidation mortgage. And that's how I met Mr. Scott Dillingham.
That's right.
You were able to obtain a mortgage based on a site visit, and COVID hit.
Yeah.
So things kind of slowed down for myself, and I did some home renovations, and now that things have picked up, I am rocking and rolling in the commercial mortgage space. I've got a good team. I want to grow the team. I would like a new agent in the Maritimes and one in Western Canada. It's complex. It's shifting constantly. We were doing all kinds of refinances on duplexes. Now I'm moving into plazas. The loan to values are changing. The whole dynamics every week is different, and it's keeping me on my toes, and I just love it.
That's good. That's good. And for an investor listening, he said duplexes. And so somebody might be like, what? You don't get a commercial mortgage on a duplex, but you do. So could you elaborate why someone who maybe is declined from their bank on the residential side, who wants to buy a duplex, how going to you through commercial, how that changes things?
Yeah. First of all, one of the reasons they may have been declined by the bank is that they're personally at their limit, right? And that's the main reason, or that their income went down during COVID. Could be a number of reasons why they got declined at the bank. The first thing that a bank will look at on the commercial side of the thing, on a commercial mortgage, is the income generating capabilities of the property. It's property first and foremost. It's the appraisal, it's the rent roll against the expenses. And the big banks are looking for about $1.30 in income for every dollar in expenses. Credit unions are a little more lenient and even a little better, higher loan to value. So they look at that first, is that whole property's financial situation. And then they'll back it up with a personal net worth statement. It doesn't have to be all that strong a personal net worth statement. It just has to basically say that this duplex, if somebody was to leave today, walk out on their lease, can that mortgage be covered for 1 or 2 months until it's back on the market? And so I highly recommend that it's done on the commercial side, because it then, again, removes some of the stuff on your personal side and allows you, as you move forward, to buy a bigger primary residence, because it's not all tied to your personal net worth.
I love it. So just to recap, because I understand your terms, but maybe somebody, this is all new to them. And before I actually reiterate that, just to confirm though, would you say, because I tell people it's like 90 to 95% about the property and commercial, and maybe 5 to 10% about the borrower. Would you say that's accurate?
Yeah, I'd say that was accurate till about 2 weeks ago. And I'd say she's about 80-20 now.
80-20, okay.
Yeah, I would
Good
say.
for me to know.
Yeah, because of they are evaluating the commercial properties a little more stringently today than they were
Okay.
a couple.
And they're doing that on the residential side too. But just to go back to recapping, so pretty much what Mike is saying is, say your bank does say, no, you're at your debt ratio limit, you can't afford anymore, or like he said, your income went down from COVID. On commercial, maybe 20% of your application now is based on your income, and the other 80 is the property and what it generates and what it can do. So I have seen Mike actually get clients who, on the residential side, we couldn't help them. We could get them a private mortgage. But then through commercial, Mike was able to move forward. When I knew, and I actually knew about these opportunities before starting the commercial division or having Mike start it, but the idea to start it. And I knew that this was an avenue for investors to really grow and expand their portfolio that other brokers or agents or people were not looking at. Because if you look around, very few people actually have a commercial team in-house where we do. So it's really, really cool. So I think that summarizes that. But could you talk maybe a little bit more about, so the lenders are tightening up. We do know this, right? Because the market's cooling. We're at the end of 2022, pretty much by the time we're recording this. What are you seeing in the marketplace so that the investors can be aware of this and maybe strategize a little bit better?
One of the new things that I'm seeing is fair market rents. Now, one of the issues that just has happened recently, and why less duplexes are getting refinanced, is everybody thought that, well, my property just almost doubled in value and that I'm going to be able to take out half of the value of the property. It's all about what the rents will support. And so there was some confusion amongst clients in that area. The best scenario, or the best avenue, is actually a vacant property and going in there and doing some renovations. So you get a short-term private loan or a short-term variable. Some of the lenders are doing, or short-term fixed. Some of the lenders are doing that with money for renovating, on the condition that without a penalty for breaking the mortgage. As soon as the property's done and it's reappraised, then it goes to a conventional mortgage. So I'm seeing more of that. The rate's slightly higher than a regular fixed 1-year rate, because you don't have to pay the penalty. When you're done, you reappraise, refinance, and you're in business. Now you can set fair market rents.
Yeah.
Versus legacy rents. That's been a tough thing, is that the rents have not gone up to support the new mortgage amount if somebody's trying to take some money out. What I do find is that the more units in a residential commercial property, the higher loan to value you're going to get. For example, if you purchase a condo, you've got one tenant, that tenant leaves, then you've got a couple months of repositioning the condo. Whereas if you have a duplex, then you've got that other lease to continue to support, so it's less on you personal. You get to a fourplex each one of those stages, the loan to value increases.
Okay.
So that's something to consider. And those properties are Windsor had an abundance of them until a lot of them got consumed or over the last, with the rates the way that they were. So I really think that these programs that the banks are adjusting. Yeah, I mean, they're adjusting, and I'm just seeing this stuff change every day. And for example, I have a client that's buying a unique property, has plans for it, has limited down payment, but the bank is prepared to work with that client and give him a short-term higher interest rate, 7.7%, higher interest rate to get the work done, enough money to get the work done, reposition the property, and then refinance it without a penalty. So that's one of the areas I see things moving. And that is also not just commercial or residential. That's happening with plazas, because plazas were devastated, right? Or still have so many empty storefronts. They're looking at that. If the investor is willing to take some of the proceeds, upgrade the facility, because a lot of these plazas are somewhat older, and then get it back on, reposition that property, the banks are with them.
Okay.
The banks are with them.
No, that's cool. Now, without saying the business name or the exact property, can you go over like the different class of properties, like retail, apartment buildings? Like, could you touch on some of the stuff that we do in the commercial division?
We've done just about everything. We've gone to the goal line on a $12 million industrial complex. We've done industrial where it's the office up front and the small manufacturing in the back. That's sort of like a tool and die startup or a fixture engaged startup. That falls pretty heavily on the business itself. You need 2 years taxes.
Okay.
One of the other things I want to mention before I go there, though, on the commercial residential, is that if you set up a hold company, a hold co, to make these next purchases, your commercial purchases, it will fall on you personally, your PNW, to support that new hold co. But after 2 years, the hold co's generated enough revenue, and you acquire properties under the hold co. So there's some advantages to that.
Nice.
So that's what we're seeing a lot of right now with these smaller, I call them commercial condos, where you're kind of living up front, but that's the operation. That's the business. You're working up front. You're manufacturing in the back. And so you even may have two tenants, somebody in the back and somebody in the front, and you put that in the whole co. Again, it's the strength of the lease. So we're seeing more of those. Now on the plaza side, if there's an anchor tenant, the property is usually very favorably seen in the bank size versus a bunch of what I would call boutique type,
like mom and pop type stores.
Right. So you want to try to find an anchor. It's like Devonshire Mall. Right? You got Sears, you got the Bay. That's the concept of.
Although Sears is a bad example.
Yeah. No. Is Bay still there? I haven't been in the mall.
The Bay's still there, yeah.
Yeah. So I don't know. Yeah, that's a bad example. But that was the same concept that we wanted here in the city of Windsor.
Yeah, the concept applies for sure. You want a big key name player.
Casino there, a convention center there, another recreation center there.
Yeah.
Draws people within the corridor. So we are seeing a lot more retail plazas.
Okay.
We have had a couple of recent deals that are multi-unit apartment buildings. In those instances, we've had fair market rents, let's say $1,750 for a 2-bedroom apartment. But then you got the legacy rents and $750 for the same unit that somebody's paying $750. So the loan to values on those, that's a deeper pocket type investment. 50%, 50 to 60% loan to value on those types of units.
If it has a lot of older tenants.
Yeah, legacy leases.
But we work with investors to turn those over, because sometimes investors turn over those properties, they renovate them, whatever, re-rent them for higher amounts, right? And then they come back and they get really good like CMHC financing.
Yeah, they get that, plus they get reimbursed the renovation costs if it's a significant enough piece of property that there's multiple units. CMHC changes the rules pretty frequently. CMHC originates, you can probably say better than me because you're more residential, but helping the first time home buyer, etc. What their goal is in the multi-tenant residential commercial space is affordability.
Okay.
To continue to maintain a base of inventory of single and two-bedroom units that are affordable.
That makes sense. It's a crown corporation,
Yeah.
right?
So if you're willing to reduce your energy footprint, if you're willing to have your base rents about 80% below market rent across 80% of your building, etc., they've got some programs where they'll give you 100% financing,
Wow.
but you got to maintain that for 10 years. So if somebody's looking for a long-term investment in a building that they really like and they feel that in 10 years, my kids can inherit this or whoever,
Yeah.
then CMHC's there to help.
Okay.
But their goal is to keep people off the streets in affordable housing, under market rents. And so we've sent a number of deals to them recently, and they just haven't quite fit because a lot of investors don't want to wait that 10 years
Yeah.
to that clause in the contract.
Yeah. Which makes sense. I mean, everybody has different goals when they invest, so it differs for sure. So I know we talked about just the different options and stuff. I know some of our lenders, and again, not saying any lenders' names, but some of the cool things that I've discovered is on your commercial side, some we don't have stress tests anymore. Is that right?
Yeah, really. I
There's
used
just a
to,
handful.
I used to, for every lender, have to do out a calculation, which is debt coverage ratio, which is the stress test. And they're not asking for that anymore. They're just asking for the file. And actually, they're doing it on their own. And the test is not as stringent as it was.
Okay.
Yeah, I'm pleased not to have to actually do that. They're taking that upon themselves because it used to be that I would run the stress test and it would be consistent across all lenders that I may introduce a deal to. And one of the things that I will mention that's different, I don't shop lenders. I send a deal to one lender and that lender reviews the deal and has the right of first refusal before I'll pass it on to another lender. Because in the commercial space, it's lender relationship based. And I've worked as hard at that, establishing those relationships with lenders as I have trying to get deals done. Because if I can get a lender, like I've got a real tight line deal that commercial again takes 45 to 60 days usually.
Yeah.
And when I see a deal that I personally in my heart, I want to get it done, I know that I can call a lender that will look at it within hours of me calling him. And that's really important.
I would say too, just to add to this, is you do try to research and see the lender that will approve it, but also give the client the best rate. You're not just going to someone who's got a high rate. You know exactly what the lender can and cannot do, and you're going to them the first time. Because I agree, there's no reason to send it to 50 lenders when you know only 2 will do it, and one's a low rate and one's a high rate. So of course you're going to send to the low rate one.
And they know if a deal's being shopped. And so that's what part of our letter of engagement that we have with each client is we engage the client and we would like them to list who has seen the deal.
Okay.
So that we don't send it if it's been declined by a lender and they're now coming to us. We're not going to send it to the same lender. And because they don't like it if the commercial deal has been widely shopped.
Yeah.
Because they can see if a credit got pulled a week ago because they're looking at someone's PNW to support a deal and they pull the credit and then this guy goes and pulls credit, goes, Mike, this was just pulled yesterday. What are you sending me? So it's important that our clients are upfront about who they have dealt with in the past.
Okay.
But the thing about us, Scott, and I know you know this, is that a lot of our commercial clients have a long established relationship with an institution. I'm finding this, I won't mention the client, but in Kenora, for example, the guy's been working with a big five forever. As their policies change and don't fit the needs of the client anymore, and you can have a massive portfolio with a big institution. We're starting to see a lot of those come our way. And they want something different. They want something that fits their needs and their ability to grow. because a lot of the big banks won't let them grow beyond a certain threshold.
Okay.
So it's seeing quite a bit of that.
And so speaking of thresholds, let's say I want to buy a bunch of investment properties and I've decided commercial is the best way to go, or maybe I'm actually looking at commercial properties, not just to have the commercial guidelines. Is there a cap to how many rental properties you guys can do on the commercial side?
No, there's no cap. Now, some of our lenders, so we deal with the front line deal assessor at the institution, establish that relationship. They have caps. So, for example, if one of our clients wants a blanket across 8 properties, that could put it at a $5 million total blanket. Whereas our frontline individual has the ability to approve a mortgage on their own, send it to adjudication or credit department at anything under $1.2 million. Okay, so if it goes up the ladder, higher rate, less loan to value.
Okay.
So in that instance, it's one at a time. So some of our lenders have, our frontline people have certain amounts they can approve. And as I say, if it is a $5 million deal and it's over their limit, it tends to go up to the next level executive. And I'm finding that when it gets there, the rate is higher and the loan to value is.
Yeah, they're tougher. Management is always tougher.
Yeah, especially when it's a big deal. So, yeah, it's a stage strategy I would recommend for most investors. We're doing a refi right now on numerous properties, and 2 are getting in at a time because they fall within under the 1.2 million that this person can approve.
Okay. Cool. No, it's interesting to see, but no, cool. So there's no caps, which is great. So that's another way. Like if somebody is not that they're maxed out on the residential side, because there are options we can still do for investors, but sometimes the options become too costly and they don't make financial sense. So we'll often refer them over to you guys as well because it's best for the client. So no, that's really cool. And you mentioned the team, that you have a team already. I know there's 3 of you and you're looking to expand. So you're looking for 2 more, you said?
Yeah, I'd love work because of your marketing engine, sir. I'm getting deals. I just got mobile home parks in British Columbia. I'm getting deals all over the country. And so, yes, I'd be looking for an experienced residential person in either one of those areas that are thinking that they might want to become full-time commercial.
Okay.
So I haven't really started to put the feelers out,
Okay.
but we'll be doing so soon because we do have enough deals throughout the country to start to spread some of them around.
That's awesome. That's cool. And I have some big things planned. So you guys are going to be even busier.
I look forward to it. As I say, I've done a lot in my life, but this keeps me. It pulls everything, all my experiences together.
That's cool.
And it's just so much fun. I get up in the morning and I go, "Oh, damn, that happened," and like that happened this morning, and it's like, how do we figure this one out? Because each day's a challenge, right?
Yeah.
And each person's situation is unique.
Yep.
And you have to move with the flow. I don't like not being able to do a deal, but with these rates changing, we're getting discussion papers, but they got to put the word out there that the rates are not what they were.
Yeah.
So I'm hopeful that it stabilizes and potentially in the 3rd quarter of next year,
Yeah.
maybe we start to see a little bit of drop. But the reality is that unit 3 weeks ago that you might have been able to take 200 grand out of, you can't right now.
Yeah. You take maybe, I'm making a number up, but maybe it's 150 now, or because the rates went up.
Yep, exactly.
Yeah. And that happens on the residential side too, right? As the rates go up, the stress test increases and it shrinks there.
The opportunity in that instance is as well as the property values are going down. So that 200 might have been able to buy the duplex 2 months ago. Well, the 150 will now.
Yep.
So it's a trade-off.
Yep. I agree. No, that's awesome. So let's say you're listening to this, you're an investor and you want to move forward with the commercial type of application or to speak with you about the options. How would they get in touch with you?
There's several ways. You can email me directly at mike@lendcity.ca. You can call our phone number here and they can patch us through.
In our office line, it's 519-960-0370. And I know you're going to help me. I know we're wrapping this up, but we are working on an investing course, and I look forward to having you be part of that from the commercial standpoint to show the natural flow and to help investors that are stuck with their financing that don't have those options. The course is going to show them how to unlock that.
That is one of the things I'll say in closing is that I am spending 25% of my time coaching, and I love it. So if you are interested in investing in commercial properties, you're moving commercial because of what we just said about PNWs, et cetera. And so you're contemplating commercial. First thing to do is get in touch with us and we create a file. I can tell immediately where it fits in terms of what kind of property that you might be able to acquire and grow your net worth. Like I can do that in a half hour.
Which is incredible. And it's cool because a regular investor doesn't know this, but I guess it's not cool, but there's a flow of where you should apply for your mortgages first. And if you do that out of order, you limit the properties, you limit getting the best rates, the lowest fees, that type of thing. So there's a process. So if you're getting started, it's always best to work with an expert. Where if you already have a portfolio, I'm often seeing, and I don't know if you see it, but I see it on the residential side, we're redoing most of their financing because it was set up incorrectly or just not for growth.
Yeah.
And we're redoing it and making it for growth.
Yeah. And again, all those people that have significant portfolios with one institution and a long-standing relationship, that institution is going to want to continue to keep your business, but it's not always in your best interest to stay with that institution because we see all the programs. They just see that one institution's programs.
Yeah.
And we've got the Bible on what's out there.
I agree. Awesome. Thanks so much for coming on, Mike. It was a really good show. I loved having you. And we'll see you guys next time. Bye for now. If you're serious about real estate investing and you want to take it to the next level with the least amount of time and mistakes, then you're going to want to sign up for our Real Estate Investor Hub. Visit CanadianRealEstateNetwork.com and hit the blue button or banner that says Free Investor Resources. Inside, you'll have access to real estate investing courses, networking opportunities, webinars featuring industry professionals, as well as dedicated chat channels to share and get access to unique properties. I look forward to seeing you there.